Today, folks, we're going to talk about the mind-blowing, astonishing returns that we've gotten out of VDY, the ticker VDY till I motherfucking die, baby. That is the Vanguard FTSE Canadian High Dividend Yield Index ETF. What a mouthful, but outpacing the S&P 500 and a sizable position within my account. I've been so focused on individual tech stocks that I keep kind of side-blinding how great the Canadian economy has truly been performing. And we're going to compare it to my other favorite monthly paying ETFs here in Canada, like XDIV and XEI. So if you are on a path to financial independence, if you damn well one day want to retire early and you like being your own Jerome Powell, turning on Tiff Macklin, the money printer from the Canadian bank, considering that subscribe button, folks, because I do really love this ETF and it has become a core piece of my identity here in the influencer realm of YouTube. But year to date, VDY is up 7.7% against VFV, which is the ticker most Canadians buy to get exposure to the S&P 500 and the US. I would prefer to buy the native currency version of VOO in a US dollar account. That way I don't have to deal with the conversions, because VFV shows you the converted price to Canadian dollars, which we know the US dollar has been declining, leading to an increase in the value of Canadian dollars. And that has actually hindered the stock price performance that we see in this chart. So if you were Canadian, you bought VFV, you're only actually up 4% on the S&P 500. You'd be up 7.7% on VDY, excluding any dividends. And with the higher yield coming out of VDY, you'd be up substantially more. But it gets even more impressive the longer you zoom out. On the 1 year here, VDY is up 17%. You include the 4% yield that this thing offers, and you're actually up 20% plus. Whereas VFE is only up 16%, probably 17.5% with the dividend. But if we zoom out even farther, I'm shocked to say that over the last 5 years, these have been very comparable returns. I mean, if you include the 4%, if you went back there, you're probably getting closer to 5% all the way back 5 years ago, more toward the bottom of the pandemic era there. But you'd be up 82% in VDY. You slap on that yield over 5 years, guys, you'd be up literally almost comparable, a little bit higher than actually VFE has offered in returns. That is absolutely insane to me, and it is one of the reasons that it is one of the larger holdings within my portfolio. And just for newer investors that are unaware, this has a very low expense ratio of 0.22%, a 4% yield. It's got a great dividend growth rate behind it, because again, it's a market cap weighted ETF that basically just gives you exposure to Canadian dividend stocks solely, which is what I'm after, because I don't like all aspects of the Canadian economy. I always feel like tech has been very valued and is better off kind of trying to pick and time some of the tech plays like Shopify. I don't know what it is with Canadian tech, but I always find they seem to run to pretty extended values. And comparably to the S&P, you'd be shocked at the underlying difference between these ETFs as well, because the price to earnings ratio on this one is 4.5 times or 14.5 times, so 14.5. Comparably to the S&P that trades in the 20 times multiples. The growth rates are comparably much different here, because I think the S&P has a growth rate of like 20% on earnings, whereas this is at like 6.6%. Yet the returns of these have been very comparable. And you want to look at like the return on equity, price to book value is only 1.7 times. The underlying fundamentals are extremely more cheap. They're not that cheap today because the values have rallied so much, but even compared to the broader Canadian index that does trade at over 20 times, this is just a much more fundamental play, in my opinion, if you're a fundamental investor that cares more about the underlying value of the assets you're buying. But still, I'm not saying it's cheap today either on the growth rate, but it is just much different comparable valuation metrics. And if we take a look, you get mostly exposed to the financials like Pokemon cards. You got to collect them all. So when it comes to the big banks, we'll talk about them more in a minute. It's one of the reasons that I like this ETF, and it's one of the reasons I sold almost all my Canadian stocks, because I used to have a lot of exposure to the individual banks, to realize that owning them all is better than owning them individually. And this helps me cost average 55%. We'll take a look in a moment, but energy at 26%, utilities 5.8%, telecommunication at 4%, basic materials at 3.7%, consumer discretion at 3%, technologies in here at 0.66%. There's like one or two technology companies, consumer staples, a little bit of real estate and industrials as well. If we take a look at the upper weightings, and I want to break these down because these are primarily what would drive most of the core performance, but I'm finding that it's actually the lower half of this ETF that is crushing and what I think is driving up a lot of the returns today. And I told you guys, you want to be a bit careful. You don't want this to be a total ETF in your portfolio just because of the concentration risk. I mean, Royal Bank and Toronto Dominion make up almost 25% of the entire return. So these two stocks alone will be the defining factor to a lot of the movement. And we know TD's been crushing it. We know Royal Bank has been doing very well. I'm happy with this. This is how I would prefer to be weighted, just for me personally, but you might be different and you might be more interested in some of the ETFs we'll talk about in the latter half of this video. But still, you get Enbridge, Bank of Montreal, Bank of Nova Scotia, again, all market cap weighted. So there's no rhyme or reason to how you feel about these companies. It's just the underlying performance of the market cap. Market cap gets bigger, gets a bigger weighting in the portfolio. Market cap goes down, gets a smaller weighting. It's a very beautiful system. It's my favorite way of investing, hands down. It's why I primarily have exposure to just VDY and VOO as the primary core positions of our accounts. But if we take a look, one of the reasons why I like this so much is throughout its entire history, it's offered double-digit rates of return. Excluding inflation, which will peg this down a couple percentage points, but nonetheless, the 10-year average here has been 10.2%. You do have to minus the fees out of this, so you're paying that 0.2% management fee. So you've been getting almost an exact 10% annualized rate of return. 5 years, 17.5, 3 years, 12.51. These are absolutely nothing short of incredibly astonishing. Very comparable again to the S&P in return. And I was looking at trying to figure out what were the primary stocks driving the growth. In the mega cap bank side of it that are upper weighted here, obviously TD has been the accelerant, I think, to this ETF. Because we all know TD, after going through its insane U.S. scandal with the whole money laundering thing, paying huge fines, getting asset cap, probably got oversold. People recognized the asset value was still there overall, and they really picked it up. I mean, it's trading up 32% year to date. The rest of the banks, surprisingly, all green, with Bank of Nova Scotia being the worst performer. National Bank, I didn't add to this list. It's also in this ETF as well. But these are the mega caps that just really move and control a lot of the weight. And again, I'm perfectly fine with this because, again, the Canadian banks have survived the '08 crisis. They're globally recognized as some of the most resilient banks in the world, and I love them for that reason. So I'd rather have upper weighted exposure. Unlike the US, it's upper weighted tech. Our indices in Canada are mostly big financial institutions. Royal Bank is Canada's largest company. We also have Enbridge. Enbridge is the next biggest holding under Toronto Dominion Bank there. As we take a look here, guys, I just want to reiterate that just so you can kind of get an idea that Enbridge, huge weighting here at 7.7%. And I actually just took all the other energy stocks that were upper weighted here as well. If you take a look, we also have Canadian Natural Resources, TC Energy, Suncor Energy. And if we take a look, even all of these, with the exception of two of them that, TC Pipelines is down 3.3, Canadian Natural is about flat, 1.5. If you include the dividend, most of them are flat, with the best one being PPL Corp. I was quite surprised to see that some of the lower weighted ones are doing quite well, but nonetheless, the energy sector has been mostly flat and comparable if you combine all those stocks. With the other, like Manulife, you could talk about some of the insurance players, which I think are going to have more struggles because these, companies collect premiums, they collect your money, and without whatever they don't pay out, they have to sit on as cash. So they were making a lot of money off the higher interest rate environment. Now that that's kind of going away, I think their returns are going to start to diminish a bit because we all know this was one of the best performing sectors of 2024 into 2025. But if we take a look at the entirety of the holdings and we get away from kind of the top or upper weighted ones and you just scroll down, I mean, there's so many great companies to mention in here. I want to talk about like Nutrien, TELUS, Fortis, Power Corporation. You don't realize the exposure you even have to precious metals that are listed in here, like B2 Gold Corp. And if we just kind of scroll through some of the best performers, look at Nutrien, up 32% almost this year. And Nutrien still kind of upper weighted, but only makes up 2.2% of the portfolio because, again, it's only a $40 billion market cap, but up 31%. Fortis up 12%. TELUS up 14%. These are all high yielders too. I mean, Power Corporation is up 26%. The company that gives you exposure and owns a good chunk of wealth, Simple. This one yields 4% right now. TELUS yields 7.4%. Fortis yields 3.66%. Nutrien, apparently, I know it has a dividend. I'm looking at the New York Stock Exchange. I should look at the Canadian ticker, but still great yielders, right? Brookfield Infrastructure Corp with a 4% yield, up 5%. B2 Gold Corp up 27%, guys. London Gold, this one's up 102%. All these are great exposures to have in the Canadian economy, right? And these are the ones that I think are really helping drive this underlying growth that I'm just trying to figure out where it's all coming from. And yeah, I'm just absolutely astonished, and I applaud this ETF in this kind of market environment to keep up with the S&P. And again, the longer you zoom out, obviously, VDY has not kept up with the S&P 500 at all. But in the shorter term, because this was the era where technology really had its growth rates, and obviously technology fully surpassed the idea of traditional financial, energy sector like stocks. But because now we're in this shifting era where commodities and gold have done so exceptionally well, it's really helped upper lift this bank against tech stocks that have actually been quite valued in the market and actually been trading at higher price to earnings and haven't been offering the same rates of return because their market caps have expanded so dramatically, and the laws of large numbers make it hard to go from a $2 trillion to a $4 trillion market cap, where some of these gold companies are relatively smaller weighted, and now that gold's expanded so dramatically, they're able to grow at 100+% ranges right now, which is always a great reminder why you need this kind of diversity in one's portfolio, because technology will not always be a leader, though again, I've made a vast majority of my wealth off basically the technology sector over the last 15 years, 10 years. I think it's something that's going to continue, and I want that exposure to it, but I recognize why it's so prevalent to get this diversity as well for moments that come into play like this. And it's great to have a bit of cash flow. I'm a proponent of a well-diverse portfolio of just not growth, but dividends as well, and looking at the total return that can offer to one's portfolio. And in times of weakness, when companies are still generating cash flow, it's great to take those earnings and have a capability of reinvesting them into other stocks that might not be doing as well. That's why I don't like having full exposure as a growth portfolio, but obviously I'm more lean toward growth at the age of 33 with a longer time horizon and wanting to excel my portfolio at a faster rate. But still, looking at XEI, this is one of my go-to ones if you're in, say, retirement. It's got a very long-term track record. The returns have not actually been as stellar as I would prefer them to be, which is why I'm going to talk a little bit more about XDIV. But XEI is one of these ones that I recognize is, you're going to give up some return, but if you're purely looking for cash flow and stability, this is probably a better idea. If we take a look at the since inception returns, it's only been about 7.58%. Not too crazy. I'm always looking for double digits at least, because you do have to take into consideration the inflationary rate, which really bites down some of these returns. But the 1 year has been great, up 21%. 16% over 5 years overall in the shorter term, because again, the exposure that Canada has offered to the energy, the banks, the commodity market, it's done so well. I think it's the same reason in the shorter term it's done exceptionally well. So what I would say is, yes, it's offered an annualized of 7%. After inflation, you're down to about 5%. So you can imagine that your full rate of return is just coming from the dividend yield. That's about 5.58%, with an expense ratio of 0.2%, right in line with VDY. I'd have no problem buying this if you wanted to mix it into a dividend-oriented income portfolio, because no one stock in here makes up more than 5%. You get Toronto Dominion, Suncor, Royal Bank, Nutrien, like a lot of these great companies, TELUS, Fortis, some of Canada's most premier dividend stocks, but a little more diversified and equally weighted across the board. But that does come with lack of performance, right? Which is why XDIV, I think, is another comparable to VDY. It doesn't work off market cap weightings, but it does upper weight what it considers to be better, fundamental companies that have high yields. And we can see that it is also offered pretty stable returns, very nice, steady up into the right like returns. And XDIV right now has offered about 10.89%. It's actually very in line with where VDY has offered its returns. And if we take a look, the yield right now is about 4.22%, trailing 12-month 4% there, a little bit lower of an expense ratio at 0.1. And again, a little more concentrated, but diverse as well. You're not going to see a Royal Bank in here making up 15%, but the upper weightings are mostly 10% holdings. And as you get toward the lower part, you're seeing about 5%. So, I mean, the vast majority of this ETF is controlled by the top several stocks, making up over 50% of the holdings. But again, it's still diverse, but concentrated in the same way almost. So you can see why the returns have been very comparable to VDY. But I think this one kind of gives you the best of both worlds almost. It's a lot more diverse than VDY, but also concentrated, if that makes sense. So I like all three of these. These are like some of my favorite 3 dividend ETFs that you can get out of just pure play Canadian dividend stocks with great dividend Geiger growth rates on the underlying dividend returns, because that's why most people are buying it. And I'm a guy that, again, always looks at 2 aspects of a dividend portfolio, which is I need equity growth. The stock should always be going up over time, and the dividend should always be growing over time. And you can typically get this at around a typical 4 to 6% yield, depending on the market conditions, especially if we get a good correctional period. Sometimes these yields can go up to exceptional levels, like VDY used to offer a 5% yield. In my portfolio, I think I've locked in over 4.5% because it has rallied quite extensively extensively here in the last year, so it's been great to have exposure to, and I'm not done buying these. I will still cost average even at these levels. But yeah, I'm blown away by what we've seen, and I love the stability of these. And I'll pass the question off to you. What are your favorite dividend stocks, especially in this volatile market? I think this is the most premier way to get that exposure, but like, how are you playing the Canadian dividend market? I'd love to hear about it in that comment section below.